Hey, what's happening, guys? Dan Darrow here with another Options in Play video update. Today's video is the Hedge video round 2. And basically what I'm going to go over is kind of a follow-up to last week's video talking about hedges, and also some plays that are still out there, actually, surprisingly, so that haven't really responded to the overall market at this point. So first off, I mean, what a difference a couple weeks makes, right? 2 weeks ago, 2 weeks ago, it seemed like we were going to inevitably break out to all-time highs. Markets just kind of grinding higher. Last week, the selling started to come into the tape, right? We started to see some down sessions, some double-digit down sessions, but nothing like what we've seen so far this week. With yesterday's like 8-9 point down day, really a major distribution day, the likes of which we hadn't seen since February. So days like yesterday don't come around too often. So obviously it catches everybody's attention when they finally do, right? So what I want to talk about is, first off, what I spoke about last week in the first Hedge video, and at the time, this was with the spiders, around 287, 288, I believe. I wanted to at the time highlight how, yes, we may have dropped and you may have missed the first move, but there were still opportunities out there, right? So at the time, I talked about the VIX. It was trading at 14 to 15 area, and what I said was typically on at least recently, VIX moves have tended to top out around 19 or 20 at the minimum, right? You could see really obvious 19 to 20 has been the high on several occasions recently, and then with if there's even greater fear or a little bit more uncertainty in the market, then you could see moves to 25 or even above that. So what's happened? 15, and now we're through 20. So that's played out, right? Gold was another name I talked about. So I said gold can act as an kind of like a flight to safety, but also like an inflationary name, right? So kind of like a double whammy of people piling in for safety asset, but also can catch some bid from people that are worried about inflation. But when you combine it with like an interesting technical setup, so last week when I was talking about it, it was hanging right at the top of resistance, flagging right at the 50-day. A little bit of a head fake, but then today just a monster breakout bar, right? Kind of gave you plenty of opportunity to get involved. A name that typically, well, not typically, but it occasionally performs well when people really start to get nervous. And it was a really nice technical setup, and then all you needed was that surge in volume, which you finally got today, and then you get like this really nice long-term trend breakout, pent up move, which is what you're seeing. So that's played out. And the third thing I spoke about last week was the spiders themselves. So at the time we were up around 288, 287, let's say in that area, right? And even though we'd pulled back, I, I wanted to show how it was more of a much more modest move than any type of recent corrections or dips we'd seen. So June being a pretty easy comparison, top to bottom, we had moved about 11 to 12 points off that high. I mean, that was more of just like a standard run-of-the-mill pullback versus some of these other moves in March, which was about 25, and April, which was about 30. So yes, we dropped about 4 points, say 4 to 5 points off that 52-week high, but in the grand like scheme of things, I mean, most pullbacks over the course of the last year or year and a half had been much more substantial. So looking at the spider, just options out through November 16th expiration, they were only pricing in about a 9.5 points, and the implied volatility was about 50% of its typical long-term historical implied volatility. It was about 11.5 implied volatility versus 22, 23 long-term historical volatility. What do you know? Fast forward a week, and now the spiders from that point have dropped what, almost 14 points. So right there, like that straddle. So even if you didn't want to buy the upside calls, I mean, if you just bought the straddle, right? Like from 9.5, it's now moved to 14. If you just wanted puts, there's a different story. But talking about those puts, implied volatility of 11.5, currently November 16th at the money, puts are trading closer to 18 and 19. So you could see what happens when you start to see like this major selling is that, yes, obviously like puts are going to move in value because the SPY drops, but also you see that this surge in implied volatility, which also is something that can really dramatically affect the pricing of puts. Okay, so that was last week, right? You would think, all right, now that we've finally pulled back, like all of the typical hedge strategies must have played out. Well, surprisingly, no. First off, SLV, it hasn't really gone yet, right? We were messing around with this, trading this in September, and now you're starting to see gold get going. And what's silver doing? It's a very similar setup to what gold was like before it really took off. So, I mean, this had an exhaustion gap reversal, right? Then it stalled at the 50-day and this 14 area, which has been resistance, pulled back, held a higher level of support, right? So 13, and then support stepped up to 13.5, and now it's snapped right back to the 50-day. So if you can get money coming into silver like gold, you get like a little bit of a flight to safety, but also inflationary risk, and it takes out the 50-day, then you got a clean shot to 14, and through that you get a pent-up move. And really the most obvious target lines up almost perfectly. So you got 14.5, right? That was support until it broke, and then it's right where the 100-day is, and that's a pretty big move. And it's something that hasn't really responded yet to all of this volatility. So that like we talked about gold last week, but now it seems like gold's working, and now might be silver's time to play catch up. And second, utilities. Right? Nobody really likes trading utilities much, but in periods of volatility, they can tend to see some money plowing in. I mean, people that are hunting for yield or for some sort of stability will plow money into utilities. And yes, they did tick up to their 52-week high yesterday, so you could see that like money started to come in. But then today's move provides an interesting opportunity, right? So you could see that they start performing well as the selling picks up, ticked into the 52-week high, but stalled right at it and now pulling back. So yes, they started to wake up, but today's move offers a kind of an interesting opportunity because it's still holding above like the top of resistance, right? And it's right at 50 and 20-day moving average support. So what you're looking at is if it firms up from here and it follows through on this really nice rebound and it starts to see money piling in, right? Then the longer out you go, the more interesting it gets because it has above this 54.50. If it gets through that with volume, then what you're looking at is really an obvious open area up to retest prices from the end of last year, which are 57-ish. So that's about a 5% move that could there's visibility on the chart for about a 5% move in the XLU if they start to see like buying, which already traders kind of tipped their hands last week, said that okay, yeah, as things started to deteriorate, XLU started to perform well. So today's down, but in the grand scheme of things, people already showed that they were interested in utilities when they started to bid them up last week. So this pullback could be kind of a quick snapback and then set up this potential breakout and run up to the end of last year's kind of resistance area in 57. So long story short, right? Volatility is great for traders. We love it. Offers a ton of opportunities, but even if you aren't active and maybe if you just have a portfolio of stocks and long only, options really provide a great way to hedge risk, right? You got defined debit, defined premium. You know what you're risking. It's the money you pay for the contracts. And if you have Apple stock, you can buy Apple puts because that provides a hedge, right? It's so if you're long Apple stock, you can't short Apple stock clearly. But if you're long Apple stock and you have Apple puts, then it provides some way to hedge out. So options are great because they can hedge. In terms of like the overall environment, there's still hedge opportunities in names that typically respond to this type of volatility, but haven't really yet. And that's what I wanted to highlight in today's follow-up video. So I hope this is helpful. I hope you guys are enjoying all of like this crazy market action. Amazingly, earnings season hasn't started yet. It'll start tomorrow. So expect it to get even busier over the next few weeks. So buckle up, right? Have a fantastic night. And as always, reach out. Love to hear from you guys, questions, comments. And I'll talk to you guys all tomorrow, right?